Hello and welcome to episode 1 of the ICT Forex 2024 mentorship. Now, I have received a ridiculous amount of messages and questions regarding this mentorship, and I'm going to spend the first 5 or 10 minutes of this lecture to answer some of those questions and get you into the mindset of how you should approach this mentorship and hopefully what you should learn from it. Now, the focus of this mentorship is going to revolve around DRT, or dealing range theory. Before the trolls start coming out and saying I'm rebranding, I'm not, right? Everything that I'm going to discuss in this mentorship is pure ICT, right? ICT is the only person I have learned all of these concepts from. They are not my own. I'm coining the term dealing range theory because it's just easier for me to explain certain things. When I'm referring to DRT or dealing range theory, it encapsulates a number of things, right? ICT has taught everything that I'm about to show you. All I'm trying to do is use this mentorship to bring in a few different components of ICT and show how they all blend together and how you can build multiple models. I'm not here claiming that I'm the best educator or mentor in the world. I'm a student just like you guys are. And ICT hasn't yet released everything, so I'm still learning just like you guys. I'm just a little bit ahead in the journey than the majority of people out there. This is my 7th year with ICT concepts, and I learned directly from ICT as one of his private students. In my opinion, this is the gold standard of technical analysis. Whether you like Michael or you don't, there is no denying that the impact he has had on the trading industry has been huge. In my opinion, over the next 5 to 10 years, I think ICT concepts will become the benchmark for retail traders. ICT has finally given us a curriculum that actually gives us a reason of why price is going to move, how it's going to move, where it's going to move to. Now, despite this being my 7th year, I have still an element of imposter syndrome teaching this because I know that all of the information hasn't been released. But what I want to do is give you my experience with using ICT concepts, the pitfalls that I've had, what's helped me in this journey, and hopefully somebody can take something away from that. There are other great educators in the space like myself who have come out and tried to make ICT concepts a little bit more digestible because his library is absolutely enormous, right? Now, I know that ICT gets a lot of stick on social media, and I think that's predominantly down to the way he conducts himself online. In my opinion, I don't think he needs the theatrics and the drama because his concepts alone are good enough. Now, a lot of my old students who have been with me for a number of years, they know my teaching style and I try to keep things extremely concise. This is why I'm spending the first 5-10 minutes of each lecture just talking a little bit about psychology, a little bit of mindset, motivation, and to answer the many questions that I get on a daily basis. I feel like this is an easier medium for me to answer those questions rather than typing an essay to each of you individually. And what I have found is many of the questions are repeating. A lot of those which I'm going to answer within this mentorship. How to determine bias. Which order block am I choosing? Which fair value gap am I choosing? I'll be going into time and macros. I'll be going into the many different personal models that I use. I'll be showing you where to place your stops, where to take your profits, and how can we use dealing range theory or DRT to help flesh out where high probability setups will form. Now, the advanced course on the market maker model, which I released last year, was the language that I needed to teach in order for me to run this mentorship because it is very detailed. Although I've done, I think, a reasonable job of keeping it under 2 hours in length, it's very concise and packed with a ton of details, but I had to teach it conceptually first. Otherwise, I'd be having to explain everything in this mentorship again and just be hours and hours long. Now, it's not important if you haven't gone through it, but it will give you a huge advantage because I've really broken down every single component of the market maker model and dealing range theory in that course. Now, if you haven't gone through it, it's not the end of the world because I'm going to teach a lot of it within this mentorship itself. My goal here is to help you read ICT algorithmic price action. I cannot teach you how to trade. Unfortunately, that's going to come by way of experience. It's going to come by a lot of trial and error, a lot of lessons that you're going to learn along the way, a lot of drawdown, but nothing worth having comes easy, right? I'm going to try to not go into the crazy detail that I went in with my last mentorship. That was really for advanced students. And when you join that mentorship program, that gives you direct access to myself and my community. Now, the reason I've done that is because I want a certain standard in that community. We have some monsters in that community, and I don't have to babysit them, right? When there's a question, then usually it's quite an advanced question which I can answer. But the reason I haven't opened up my community to beginners is because from past experience, it's relentless with the questions that I get. And it was pissing the wife off. I was checking my phone every 2 minutes. And unfortunately, it's just something that I have to consider. Right? This mentorship is designed for more of an intermediate level. Unfortunately, it is not beginner friendly. I have created a free ebook, which I'll link in the description below, which will help you get started with the main ICT concepts. There is a video version of it available on the website. In the summer, maybe July, August time, I'm looking to do an 8 or 9 week intense boot camp. So that will get you from a beginner level to a good intermediate level. And that will bridge you nicely into the Advanced Market Maker course, where I really go deep into dealing range theory. For the purposes of this mentorship, I'm going to try to keep it simple. I'm going to use a handful of ICT concepts that repeat in price, and hopefully during the course of this mentorship, I'm going to help you train your eyes to see these signatures in price. And I believe that understanding the dealing range unlocks all of ICT's concepts. Now, I haven't done mentorship slides for a while, so when I sat down to do these, I got a little excited, and 200 slides deep, I thought I'm gonna kill them off on the first day. So this is gonna probably be a little bit longer than I was anticipating. It's great value stuff. I mean, really, get a notepad, and if you need to stop and rewind and go back, then please do so. When I get into the teaching portion of this mentorship, I'm very concise. I don't digress, and I pack it with a lot of detail. Again, all credit to the boss, ICT. Without his work, none of this would have been possible. Now, before I forget, I really need to make this clear as well. I am not a financial advisor, right? Anything that I say within this mentorship, or if I am calling where the market is likely to go, these are just my opinions only, and I could be wrong. The goal here is for you to be independent of anybody, myself or ICT. And all I am doing is giving you my internal dialogue of what I can see in the markets using my experience with ICT concepts. I get dozens of emails every single day from people who want to better their lives but can't afford the education. So I hope you guys can get something out of this. I will do my best to guide you through these charts as well as I can, but ultimately it's going to be down to you. Now, normal retail logic really relies on stuff like support and resistance, right? All of us learnt that when we were coming up as traders. And in here, I want to show you what true support and resistance looks like in the market. Now, dealing range theory, or DRT, will encapsulate both forms of support and resistance in the market, which is based on, number one, a raise in price, and number two, grade levels. Now, what are grade levels? If we grade this entire range from high to low, and we split this range into 4 equal quadrants, this gives us our grade levels. Or you may hear me referring to these as DRT levels, just to show some sort of distinction between different grades and grade swings and standard deviations, which again I will get into. But when I refer to DRT levels, I'm specifically referring to graded levels inside of a dealing range. Now, you can use your Fibonacci tool, or I use this little box thingy down here. I'm not sure what it's called. I think it's like a GAN box or something. And I adjust the levels so I have it going across horizontally, and we have the levels set at 1, 0.75, 0.5, 0.25, and 0. Or this is the 25% DRT level of this range. This would be the 50% DRT level, the 75% DRT level, and the 100% DRT level, which is obviously this high over here. Now, the 50% level is also known as equilibrium. Now, this is the most important level inside of dealing range theory. Why is it such an important level? Well, according to ICT, the market operates on fair value. I classify fair value with 3 different things. 1, fair value is going to be the mid-level price of any given dealing range. Now, why would the mid price be classed as fair value? Well, this high would be the highest price inside of this range, and this price down here would be the lowest price. Therefore, the mid price is a fair price between the highest price and the lowest price. The market will gravitate back towards equilibrium, since equilibrium is fair value. Now, the other two parameters would be to offer buy-side delivery to areas where we have only had sell-side delivery. So like we have this sell-side imbalance over here, and then we've had buy-side delivery back through that range. And the third type of fair value would be offset accumulation and offset distribution, where liquidity in the form of willing buyers above old highs is distributed to willing sellers below old lows and vice versa. This is a fair exchange. So in short, the algorithm is really going to do three things: reprice to equilibrium, reprice to old highs and old lows to seek liquidity, and to rebalance inefficient price action. Above equilibrium, we have a premium market, which can be split into premium in the lower quadrant and extreme premium in the upper quadrant. And below equilibrium, we will have a discount market, where the upper quadrant is our discount and the lower quadrant is our extreme discount. Now, despite being in a discount market, we can still view these as a premium and discount inside of a discount market. And we can view the upper quadrants as a premium and discount inside of a premium market. And each quadrant can be further divided into premium and discount. This is a 2-monthly chart, so this is a very high time frame. And since price is fractal, so are dealing ranges. Now, the market will move from premium to discount and discount to premium. And if you break each of these quadrants down and you study how price moves from premium to discount and discount to premium, there is a lot of insight that you can glean from doing that study. Now, how does a dealing range actually form? So in this example, you can clearly see that the highest high on this chart is up here, and the lowest low on this chart is up here. But for this to qualify as a valid dealing range, it has to do two things. It has to run previous liquidity on the buy side, which we have done here, and it has to run previous liquidity on the sell side, which we have done here. So both buy side and sell side liquidity inside of this range, which is a dealing range in itself, has been purged, thus making this high to this low the new dealing range high and low, or DRT high and DRT low. Now that we have established our dealing range, let's look at what's happened in price action inside of this dealing range. In order for us to forecast future price movement, we must understand what price has already done. Where has price come from? Where is it likely to go next? And where is it not likely to go? These are questions that I'm asking every single time I pull up a chart. Now, how did the dealing range high form in this example? We have this down close candle. When the market runs above the opening price of this down close candle becomes an order block. Now, ICT hasn't released all its information around an order block yet. And this is my 7th year in, so talk about drip feeding, right? But when we are in an uptrend, we want to see down candles supporting price. You can see how we run lower into the order block. We tap the mean threshold of that order block. Also notice how the mean threshold overlaps with the 75% DRT level. We then form this swing high. We form this swing low, which runs below this candle's low or closing price. Now, that's an important signature, since this run higher is actually forming these 3 consecutive up close candles, which will become our order block. But for now, this down close candle here is going to act as our breaker with the high, low, high, high, this last down close candle. If we extend that out in time, you can see how we've traded into it recently. The highs rejecting the mean threshold of that breaker. The 3 consecutive up close candles after running this swing high is our bearish order block. And again, if we extend that out, you can see how we have traded into it. We've rejected from the mean threshold. After we have seen price turn around over here, creating this failure swing, which failed to go above this high, we then have displacement lower in the form of this sell side imbalance. Notice where it closes, below the 75% level, and also closes below the low of that order block. This creates a valid structure break. Why? Because we have left this sell side imbalance. Again, you can see that we've traded up into this sell side imbalance. I do apologize, it should actually be anchored to this low. So we've completely closed that in. Price has dipped into that sell side imbalance here, sweeping above this high. This is something known as IOFED, or Institutional Order Flow Entry Drill. It's a bit of a mouthful, but this is a continuation pattern where we can get in sync with the move lower. Also notice the closing price of this down close candle and the opening price of this up close candle. We have our breaker and our order block. The opening price of the order block to the wick is going to be sensitive. Now, there is further confluence built for a down move here because we also have this down close candle. We nail the opening price of that down close candle over here. This is going to act as an area of mitigation. Now, once this reversal has been put in place, we can measure how low the dealing range will extend using deviations of this range projected lower. And again, I've taught where to anchor these price points in the advanced course on the market maker model. So again, I'm not going to be reteaching that here. But if you look closely, we have 4 standard deviations. That gives us a price point of 72.470. Now, this would be a good target for the market to reach for. Why not 3 standard deviations? Because we have this low to the left. And what sits below this low? We have sell side liquidity, right? So the market is drawing down to this mathematical level. We have 4 deviations of this range lower giving us this specific price level. If I extend this out, you can see the bodies over here respecting this level. Now, the bodies tell the story. The wicks do the damage. If I take the opening price of this up close candle, so I'm hovering my cursor over it, the opening price comes in at 72.470. So that's perfect. Now that we have this price level and it's been confirmed with the opening price of this candle, if we anchor a fib from the body's low to the body's high up here, you can see that the equilibrium level perfectly overlaps the equilibrium level of the entire dealing range, right? Now, this is a question that I'm often asked is how do you calibrate a dealing range? When do you know when to use the highs or when do you know when to use the bodies? I'm looking for confluences. What you're going to find here, and I probably should say this, I don't have my charts with these lines all over it. To me, I find it distracting, right? So I trade predominantly with very clean charts. I may have a few levels from the weekly or the daily, but I've taken a leaf out of ICT's book and I actually note down the price level that I'm looking at. In the beginning, it might be a good idea for you to have these levels actually on your chart so that you can see them. Eventually, you want to be aware of them, but try to keep your chart as clean as you can. Now, as you're going to see in future slides, it can get a little bit messy. But I'm going to try to do my best to keep it as clean as possible. It's just really so you can visually see the levels that I'm highlighting, especially when we move from a higher time frame down to a lower time frame, right? Note where this up close candle is forming at the 75% DRT level. We then break and close below this swing low, making this gap over here a breakaway gap. We do not anticipate price to come back up into this breakaway gap. We've already had institutional order flow entry drill here. We've already mitigated. We've already tapped the order block. Now notice where all of this is occurring in the upper quadrant of this graded range. So as price runs lower, our stops will be safe above this swing high. Now this creates another fair value gap. If we extend that out, you can see how we tapped into it here. And we have the low of this order block giving us confluence over here, and you can see how we've reacted, right? We moved from a premium up here back into a discount. We also have this fair value gap that forms here. Notice where this up close candle is forming. We fully rebalance this fair value gap. And again, if you look left, we have these two down close candles, so there's an area of mitigation overlapping with this fair value gap. The market then breaks again lower, closing back below this swing low, leaving another fair value gap. Note where inside of the dealing range this fair value gap is forming. We'll come to that in a minute. But before we see this price run lower, to purge the sell side liquidity below this low, we create a double bottom here, right? So these are equal lows. Why is the algorithm creating equal lows down here? Because it wants to induce buyers into the market, because we're taught as retail traders to place our stops below double bottoms. This is occurring in the lowest quadrant of this dealing range in an extreme discount. Now we have run above this swing high, we have run below this swing low, and this has created a new dealing range from this candle's high down to this candle's low. Notice these two up close candles and where they form. Notice where this down close candle is forming. Notice where we have this sell side imbalance. And notice where we have these two down close candles forming inside of the dealing range high and the dealing range low. Notice how we're accumulating over here around the equilibrium level. And notice how we run through the high with an up close here. Now, what do we have here? This is a consolidation. Notice where this consolidation is forming, around equilibrium. How did this consolidation form? Well, we ran the relative equal highs here, so we swept buy side, and then we ran the relative equal lows down here, so we swept sell side. This forms a new dealing range. Look where we get equilibrium. It overlaps with the parent dealing range, right? So inside of this parent dealing range, which is the major range here, we can get smaller dealing ranges that form. Now, note this down close candle here. We have a sell side imbalance. If we extend that across, you can see how we're finding support at the consequent encroachment of this fair value gap, which becomes an inverse fair value gap, right? Why? Because it's sat on the left side of this market maker model. Notice this sell side imbalance here. Again, if we extend that out, you can see how the candles here are respecting the equilibrium price point of this inverse fair value gap. Notice where it's forming inside of the range from this high down to this low. And notice where this is forming inside of this high down to this low. Price finds support over here and then really makes a run higher, clearing the buy side liquidity above these relative equal highs, reaching into an extreme premium relative to this dealing range, and fully rebalancing this sell side imbalance over here. Notice the bodies of the candles here failing to close above the consequent encroachment of this sell side imbalance. This is important, this gives us insight. Now note the consequent encroachment of this inverse fair value gap. If we split this section in half, you can see how the midpoint overlaps perfectly with the consequent encroachment of this sell side imbalance over here. Also notice that we have this swing low, high, lower low, making these two consecutive up close candles a bullish breaker. If we take that entire range and we extend it to the right, again you can see the midpoint of that breaker, or the mean threshold, overlaps with the consequent encroachment of this inverse fair value gap. How do you know which levels to select and where your high probability entries are going to occur? By blending all of these ideas together. Why is a breaker going to be a breaker, and why is it going to hold? Why is an order block going to be an order block, and why is it going to hold? It all depends on where it is inside of the dealing range. It all depends on the confluence of different arrays and levels in price, from a higher time frame down to a lower time frame. The more levels that overlap, the stronger that level is going to be. And when you bring time into it, this is everything that you need to hunt for high probability setups. So currently we're sat around this level and we've fully rebalanced this sell side imbalance. So let me zoom into this piece of price action. Now, given everything that price has already done, how can we use that information to forecast what price is likely to do next? You have to make a logical choice based on probability of why the market should move in one direction over another. Sometimes it's going to be difficult to read, right? From where we stand, we have completely rebalanced a higher time frame fair value gap inside of an extreme premium. And then we've seen price run lower, close below the 75% DRT level, and the candle bodies here are failing to close above the consequent encroachment of that sell side imbalance to the left. We have then traveled through the opening price of this up close candle and closed below this buy side imbalance. So I'm looking at this as a potential balanced price range. Now, inside of this consolidation, again, we've closed above the dealing range high with this up close candle, and we've run below this swing low over here. So the dealing range low, or the DRT low, will stay in place, but we will extend the DRT high to the high of this candle. So now we have a new dealing range from this candle's low to this candle's high. Notice how the bodies of the candles are reacting here at equilibrium, or that 0.5 DRT level. Notice that we have this buy-side imbalance, which also closed above the equilibrium price point. If we extend this buy-side imbalance to the right, you can see how we've touched and rejected the consequent encroachment level of this buy-side imbalance. And again, the bodies suggesting that they do not want to close lower, failing to get back inside of this buy-side imbalance. We also have this low, high, lower low, making this up-close candle here, so I'll take the whole range, our bullish breaker. You can see how the mean threshold of that bullish breaker overlaps with the consequent encroachment of this buy-side imbalance, and price has really respected this area. Above the market, you can see between this candle's low and this candle's high that we have this sell-side imbalance. Notice where the bodies of the candles are closing, at equilibrium. They are failing at the minute to get back above the consequent encroachment of this sell-side imbalance. Now, I'm going to take this piece of price action and zoom in onto the weekly time frame. And this is what we get here. The first thing we can see is that we ran the sell-side liquidity below these relative equal lows, dipping into that consequent encroachment of that 2 monthly fair value gap. We have these two down close candles that ran the sell-side liquidity into this higher time frame level. And then we had a reaction from this level running back through the opening price of these two consecutive down close candles. This is where we have our change in state of delivery. In between this candle's high and this candle's low, there's a small fair value gap, and you can see how we've dropped into the opening price, rebalanced that fair value gap, and price has again ran away, running into that higher time frame sell side imbalance and touching the equilibrium of this dealing range high to this dealing range low. Notice the bodies of the candles here. Price rejects the equilibrium or midpoint of the dealing range and goes lower into where the equilibrium of the higher time frame parent dealing range. That also overlaps with these two consecutive down close candles. The mean threshold, which is this dotted line, in close proximity to that equilibrium level, and again the bodies not closing below the mean threshold. Do we see a reaction from this level? Yes. Price runs higher, running back through the opening price of this down close candle. So there's these three consecutive down close candles again, and closing in this sell side imbalance and breaking above this swing high. Price then retraces into the opening price of the parent order block over here. This is what we call a reclaimed order block. Now, we can reclaim an order block if we haven't yet run the existing high. Since we have swept buy side liquidity to the left and sell side liquidity to the left, what does this make this range low to this range high? A new dealing range, right? If price fails to take the dealing range high after running into an order block, we can reclaim that order block. Now, by itself, that's not enough. What else can you notice over here in price? You see this sell side imbalance that overlaps with the opening price of this order block. We also have these three consecutive down close candles. If we extend the mean threshold across, and you can see the bodies here failing to close below the mean threshold. And again, price runs away. Buy side liquidity above the equilibrium in the form of this high and this high. And we also have the remainder of this sell side imbalance still open. And this also overlaps with the higher time frame monthly fair value gap. And it takes us back into an extreme premium relative to that parent dealing range. Now, price is showing signs of support over here. We have this sell side imbalance that if we extend across becomes an inverse fair value gap, and there you can see the consequent encroachment showing support. We have the opening price of this down close candle as an order block. If we extend that across again, you can see the overlap. And we also have this buy side imbalance. And the body of this down close candle is failing to close below the discount low of this buy side imbalance. We also have this low, high, lower low. This last up close candle, if we project that out, you can see the mean threshold again overlaps with the consequent encroachment of this sell side imbalance and the opening price of this down close candle, which is our order block. Now, I want to see price remain firm here and run for the buy side liquidity above these highs and see if we want to get at least to rebalance the higher time frame fair value gap. It doesn't need to go all the way back to this level. Now let's drop down to a daily time frame, and I'm going to zoom into this piece of price action here. Now we're finally down to the daily time frame. Everything that I'm showing you in terms of this top-down analysis, it takes me maybe 5-10 minutes to do it. And once I've got them higher time frame levels on, I don't need to mess about with them again. I'm just focusing on the lower time frames. So apologies, because this is obviously a lot longer as a lecture than I anticipated, but we have to get this out of the way, right? I made a video on YouTube a few months ago on how to identify ICT directional bias. And I did that study on the dollar index, right? Now, I said this was going to be an initial draw when we were up here. And now you can see the reasons why. We were inside of a premium relative to this dealing range. We had the fair value gap. We had the confluence of all those higher time frame levels. And being around equilibrium, I always anticipate a run below stops, right? The other clue here that was suggesting lower prices was this divergence between the dollar index and pound. At the same time, right? Time is important. At the same time as we were making a higher high here, look at the bodies staying inside of that higher time frame imbalance, we were seeing the pound fail to go lower. Now, these are inversely correlated. If the dollar index is posting a higher high, we should expect the pound to post a lower low. Since the pound was failing to post a lower low, this is a cracking correlation and an algorithmic signature to suggest that the pound has strength behind it and wants to go higher. Why? Because we have all of this liquidity here. And the dollar index is going to shift in direction and run for what? Two things: liquidity or an inefficiency. Ideally, both. And that's what we have here. I also said I wanted to see how price would react when we got here. Do we trade through it, or do we find support? The volume imbalance is ICT's strongest and weakest PD array. It's the strongest PD array when it comes to a draw on liquidity, because we actually have a gap here, right? There's no trading over here, so the algorithm is going to reach for there as a draw. But it also gives us an indication of market strength, right? Now, with it being its weakest PD array, this means that it will act as a magnet, but it can trade through it many times. When we are in a situation where we are seeing here the bodies are failing to close below the weakest PD array, what does that mean? It means there is underlying strength behind the dollar, right? And what do we see as a result? The dollar moves higher. We see price run above the opening price of this down close candle. Why am I opting this down close candle? Because there's a volume imbalance between this candle and this candle. So I elect to use the lowest down close candle that also closed below this swing low down here. So this is going to be my order block. When we trade through the opening price, we have our change in state of delivery. We also have a sell side imbalance here, a buy side imbalance here, and then we've come back into the order block and touched the premium high of this now balanced price range, right? And price moves away. I would like to see price stay firm here. We have the relative equal highs, which sits below the consequent encroachment of that higher time frame fair value gap. We are at a key institutional level, 104,500. Now, above these relative equal highs, we have this gap, right? So this is an actual gap. It doesn't have any wicks or any bodies. So this is what ICT refers to as a real liquidity void. So above these relative equal highs would be my initial draw. As a side note, look at the mean threshold of this up close candle over here. I mean, there are tons and tons and tons of things on this chart. I could talk all day. I think I've already been recording for about nearly 3 hours. So I'm going to have to shorten this down through the edits, but I still have about 50 slides or so to go. I got excited and I still need to edit this and get this out by tonight. So I'm going to pause it here, and the remaining slides I will carry forward to next week's lecture, where I break down the pound and the euro in the context of what we can see here on the dollar index. Now that I've been able to talk about the higher time frame and where we are in price, future lessons shouldn't be as long, hopefully. I can get a little bit more into intraday price action. I can incorporate different models, power of 3, market maker models, time, macros, seasonal tendencies, economic calendar, weekly profiles, daily profiles. There's a ton of things that all blend very, very nicely and gives you the highest probability behind your trade setups. There's a whole lot of detail I have missed out even just in this lecture, and I'm doing my best to try to not complicate it so much. If you have any questions, please leave a comment below.